comes to investment strategies, plenty of people swear by PE ratios, but is it the best approach to take? Not according to my next guest, who says they're verging on nonsense. Independent investment expert Roger Montgomery, welcome back to Switzer.
Thanks, mate. Well, look, they're not nonsense, they're twaddle, that's for sure.
Oh, well, you've gone soft, mates.
Well, listen, I actually think, and I know there, a lot of people are interested in how I value businesses, and I understand the fascination. The first thing you've got to do is you've got to just put away all the sort of the conventional tools, because really they've been developed for convenience, or they've been developed because people haven't wanted to put the work in to coming up with a better idea. Now, PE ratio, let me give you an example. We've got two companies, okay?
For those people who don't know what we're talking about, let's explain it first.
Okay, so let's say a company earns 50 cents a share and its shares are trading on a price earning... the shares are trading at $5.
Yes.
Okay, so we've got 50 cents of earnings, a $5 share price, so the shares are trading on a PE, or a price to earnings ratio, of 10. Yeah. Okay?
And it's like 10%.
And it's shorthand in the market. So in investment circles amongst stockbrokers and analysts, people say it's a PE 10, PE 15, the average PE is this or whatever.
Yeah. And they've also, over the years, benchmarked, like, if a good company doing well has a PE of 10, the industry...
That's seen as cheap, it's a bargain.
It's a buy.
That's right.
Yeah. But if it's 20 or 25, and that's all getting a bit scary.
Getting a bit pricey at the moment.
Scary territory.
If you flip the PE ratio over to, so instead of price divided by earnings, it's earnings divided by price. People call that the earnings yield, which is what you're referring to. Now, apparently, if you flip a dog over, it becomes a cat. But anyway, we'll talk about that in a minute.
But there are people at home who say, this guy tries to make everything so hard, so we have to buy his book.
They do not.
They do.
They do not.
Okay, go on.
They do not. My job is to make things easy. That's
of course.
Okay. All right. So I want you to imagine for a moment. So people, you'll often hear the mistakes on a PE of 10. It's good value. Yeah. Now, I have the view that price and value, just like Benjamin Graham said and Warren Buffett said, are two totally different things. Price is what I pay for something, value is what I get. Very simple job in investing, pay a lower price than the value you receive. That's the bottom line. Yeah. Okay, so let's take two companies. Let's imagine they've both got $1 of equity in the balance sheet. Okay, both of them are generating a return on that equity of 20%. Okay, which is a good result. So that's earnings. They're both getting earnings of about 20 cents. Yeah. Simple as that. Now, the only difference between these two companies... actually, before I tell you what the difference is, the other thing that's the same, they're both on a PE ratio of 10. So the share price for both companies is $2. Yeah. Right? So equity of $1...
So if you only use PE, you'd say these companies are the same.
These companies are exactly the same. Yeah. Both got the same earnings. Both of them have the same return on equity. Both of them have exactly the same equity. Both are identical. They're both on a PE of 10. They've both got the same share price. Yeah. Everything's the same. Yeah. The only difference is the first company keeps all of its profits, pays no dividends at all. The second company pays all of its earnings out as a dividend to you. Now, if I buy the share, both companies, on a PE ratio of 10, and in 5 years' time, I sell them on a PE ratio of 10, then the company that keeps all the money, pays no dividends, will give me a 20% return on my money. The company that pays dividends out, pays all the profits out as dividend, is going to give me a 10% return. Now, my question to you is, which was the cheaper one? The cheaper one was the one that gave you the highest return, wasn't it?
Yes.
So the one that gave you the 20% return was actually cheaper. But the PE ratio for both was 10. So what did the PE ratio tell us about which one was cheaper? Nothing.
Nothing.
Absolutely nothing.
How does someone work out a company's propensity to actually keep money and not pay it out? Because your argument was the company that kept the money and didn't pay it out.
Is worth more.
Is worth more.
Provided it can get the higher return. Now, if a company can get a 20% return on the money, it's got a high rate of return on equity, wouldn't you and I rather that they keep the money and don't give it to us? Because if they give it to us, we're going to put it in our bank account. You were just talking about banks gouging, right? We're going to put it in our bank account. We're going to get 2/10 of nothing, and provided we don't make a withdrawal. And so I'd rather the company keep the money and get the high rate of return. Now, without taking the wind out of the sails of your next guest, that's a return on equity that's pretty impressive. We'll talk about that, I hope, later.
Yeah, but also, Roger, that people will be thinking, but hang on, I'd like to receive dividends.
Well, that's okay.
The first company that in the long run will pay off are going to be stingy in the dividend department, aren't they?
Let me give you an example.
Yes or no? Yeah, they will be stingy in the dividend department on a relative basis.
There are companies that don't pay dividends because they can't afford to.
Yes.
Right? They're the airlines, for example.
Yep.
You know, they need the money just to keep running in quicksand.
Yep.
But then there are companies that don't pay dividends because they can actually get much higher returns, and management have worked out that they'll do a better job
Give
for
a classic name, what people are listening to you right now.
JB Hi-Fi,
Okay.
Oriton.
Yeah.
You know, the dollars that they keep turn into
so
more than
not
a dollar
just
of market value.
She's actually doing it for good business
well,
reasons.
no, she pays a dividend.
Historically then, what have been the companies that have got that routine right?
In Australia,
You've named Tory, Oriton, JB Hi, but historically, what are the names of the companies that have done that well?
Well, unfortunately in Australia, we don't have companies that sort of have the history of the US example. So the Coca-Colas of the world, the Johnson & Johnsons, you know, those sorts of businesses, the Walmarts, you know, those types of businesses have been able to retain capital and continue to expand the business and generate high rates of return on equity. And that's partly a function of the fact that their population is 13 or 14 times bigger than ours. You know, our retailers, for example, just taking retailers, they get to a certain point, they've saturated the market, and unfortunately, they either have to return all the money to shareholders, or make really silly decisions, make acquisitions at inflated prices,
or get into debt.
Or go into debt, or whatever it is to try and boost that return on equity. And unfortunately, because of the limited size of our population, you know, usually that's fail spectacularly. So what they need to do is start just once it looks like the return on equity is levelling out, their expansion opportunities are behind them, they should then pay all the earnings out as a dividend, and then it becomes priced like a bond. You can value it like a bond. It's pretty easy to do.
Yeah, but Roger, have there been companies in Australia's history where the CEO has actually tried to come that line? Be stingy?
Portman Mining was paying dividends for a long time, and then you started getting 27, 28, 29% returns on equity, decided not to pay dividends. So there's an example that comes off the top of my head.
And so have there been cases where CEOs have also gone stingy on dividend, tried to reinvest the profits, and then failed, and so in a sense shareholders lost out?
ABC Learning Centres. ABC Learning Centres wasn't paying all the earnings out as a dividend. Was reinvesting, arguably. You know, depends on whether you agree with the reported profits.
With inverted commas around.
Correct. And was employing that money at lower and lower rates of return on equity. And in fact, if you look at the annual reports of ABC Learning Centres from sort of 2002 onwards, you'll see that they declined from about 43% all the way down to less than what you can get in a bank account by the time that they've collapsed.
How does someone then work out if a company's getting it right?
Easy. Return on equity. Is the return on equity high? If the return on equity is high, and I'm quoting Warren Buffett and James Walter, you know, two guys who developed this stuff decades ago. You know, return on equity's got to be high. If return on equity is high, then you want the company to retain some profits and not pay it all out, provided it continues to get that high rate of return.
But do you expect to see the share price benefit pretty quickly, or is it a bit of a slow burn in some cases?
Well, as you know, I am no good at predicting what share prices are going to do. I can't tell you what share prices are going to do.
It's so weak when it comes to that.
Sorry, I really understand Australian investors' apprehension in leaving the money with the CEO, because there is a very rich history of stupid blunders that have blown lots of money. Classic example in the last couple of weeks, Foster's wrote down $1 billion, between $1.1 and $1.3 billion, because they overpaid for Southcorp. You know, and that's not the first time, and it's not the last time. So I can kind of understand why people say, no, give us the money, we'll make the decision about where to invest it.
So Roger, are there any other lessons? You know, well, I'm trying to get suck out of you. Okay, look, you're hard work sometimes, I've got to say.
Sorry, mate. Right, so the PE ratio, if we agree that the PE ratio is twaddle, okay, then anything that comes out of the PE ratio is also ridiculous. So things like the PEG ratio, the price to earnings growth rate, people will tell you that there's a correlation between, or there's a relationship between share price performance and PE growth rates. Well, maybe, but I'd argue it's coincidence, because the fundamental way to value a business does not require price to be put into it. If I've got a recipe that ultimately is going to end up being a chocolate cake, I'm not going to put minestrone soup in it because it's not going to work out. I don't want to put price into the calculation of value and expect to get value out, because price and value are different.
Exactly.